what's the perfect example of the classic Thoma Bravo deal?
Great example. You take CompuWare, right? The mainframe company, publicly traded, competitor to BMC, competitor to CA, the old Computer Associates, public company. Within that business, we saw two important companies, actually. We saw Dynatrace and the opportunity to invest in a business that could be very high growth and disruptive. And the mainframe business, which many investors would throw away because of the challenges of growth in that general market. We took the company private for about $2.2 billion, and we separated the company into two independent companies, going back to the point of separating your investments so you can measure, have people be accountable for results, and you can have clear line of sight into both the strategy and the operations and track it, see how it is achieving month by month. We ended up selling CompuWare to BMC ultimately, returning the capital and the investment. And then Dynatrace has become one of the most important public companies in the application performance management space, a company that we invested aggressively behind, building a next generation product, which has been wildly successful in the market, while producing high rates of EBITDA margins at the same time. In both of those situations, we backed the existing management of each operating unit, and we work collaboratively with them to achieve their goals.
Thoma Bravo has been on something of a rocket ship trajectory, right? 5 years ago, which is to say back in 2016, if I'm not mistaken, you managed about $10 billion. Today that number is what?
80.
80. So you've grown the firm, grown AUM eightfold in 5 years. How does that happen? It's pretty uncommon.
I appreciate that. And it's humbling when we started 20 years ago with $550 million under management. One important thing is right place at the right time. We can't underestimate the luck of being in software and in private equity. I say that if for the last 20 years you were in software and private equity, there's almost no wrong you can do from an investment perspective. Now, in terms of our growth of assets under management, the industry has taken us there. I spoke about this watch list of companies that we have. When you extrapolate their growth rates of 20% compounded a year, they double every 4 years in size, not counting the acquisitions that they'll do. So in order for us to pursue those same businesses, we have to have high rates of growth in capital to be able to absorb them and invest in them. The other way we did it is proving it by doing one deal at a time. At first, the deals that we did back 20 years ago were 50 million all, in size roughly. Then it was 100, then it was 250. Then it was about $1 billion. Then CompuWare at $2 billion, and now we're doing deals that are 10, but we've been fortunate to prove that they have worked so that we can keep doing larger things.
Now, if the investments continue to perform as well as they have, and if you're able to continue doing all the other things required to grow 8x in 5 years, are you growing 8x in the next 5 years?
That's going to be tough to do. And it would not be difficult for the industry to absorb that capital in the way we do business, but it'll be difficult for capital sources to put that much money in software. It's not an industry issue. The industry is there to make that investable in a very productive way, in a value-added way. It's an issue of how much capital can institutions, or do institutions want to deploy in private equity and in software in particular.
So it's a capital constraint.
Correct.
How important is scale?
It's very important, and it's increasingly important now.
Why?
Because one of the things that our team has done so well in the most innovative places in tech, in software, has been to buy the number one player, sometimes the number two player. Whether it's in a vertical, a horizontal, in infrastructure software, and in cybersecurity, where our team has a huge portfolio of companies and a great track record of success. And those number one or number two players, given their compounding rates of growth and a multiple on their recurring revenues, which is a higher number, are very large deals to do. So scale is critical, and it's more important now than it was before.
And scale translates into what? What are the, as you look at the business today and you think about what you want it to be tomorrow and the day after that and the day after that, scale translates into what?
You mean in terms of dollars?
Yes, I guess that's probably the best way to measure it. Where do you feel the dividing line is between sort of scale-derived competitive advantage and kind of everybody else?
Above an $8 billion deal. That's scale-derived competitive advantage today.
And that's where you want to be, need to be.
And I feel that's where we are now.
If you want to be, and I think that that's where you're going with this, if you want to be the sole buyer or the favored buyer of very large software companies, to the degree that you're not already, how do you get there?
We need to prove it. And once we prove it, we can take another step function increase in our industry. Once again, our industry can absorb it. Two things need to happen. The performance needs to be there, and the institutions need to be comfortable to deploy more in private equity and software.
If scale is a competitive advantage, and it clearly is, not just in software private equity, but across the alternative investing landscape, does that mean, by definition, that you need to be bigger tomorrow, and bigger next quarter, and bigger next year, and bigger 5 years from now, to be able to write bigger checks and to maintain that competitive advantage?
You do. You do. And once again, going back to it, the only thing that will make it possible is performance. And out of any other industry, the alternative assets industry is all about performance. I do believe that institutions, from the partnerships that we have with them, are slowly getting to the point where they will not perceive software as an industry, where they will see it as a business model. And that'll free up more capital in terms of allocations to the space, rather than an institution saying, I've got 25% in software, that's too much. I can't have more because I need to allocate it to some other industries, given diversification reasons. And I think we're getting there. And once we get there, there will be more capital deployed in the space.
So there needs to be a change in the mindset of the LP to accommodate this.
There needs to be a change in the mindset.
Thoma Bravo has also become a player in SPACs, special purpose acquisition companies, the blank checks. Why?
There are so many private software unicorns that are looking to go public. Why couldn't we help a subset of that achieve their IPO goals or going public goals with a long-term partner that has an actual operating strategy to help them in that mission? So we set up our SPAC, given our core competencies and what we do, and we just completed our first deal, and we're likely to do others as well.
My cynical view is that there has to be something wrong, fundamentally wrong, with a product, a financial product, if hedge funds can build a consistently profitable trading strategy around it, which they have been able to do with SPACs. Am I wrong?
I think you are. The arbitrages exist, and they get out arbitraged over time, as with any financial innovation and new system. Think about it, a SPAC is a great model as long as it's done right. Number one, individual investors can participate, unlike the difficulties of participating in the cozy world of IPOs. So our view on that is, give them real companies. Do SPACs that only have a revenue size that produce real companies. If it's for individual investors, it has some real companies in the game, not venture startups in the game. Secondly, you can project your business. Investors love that. Underwriting projections, being able to analyze them, questioning management on how they think it through, how conservative they are, how do they make up these projections? So if you're going to have projections, have accountability. Have every company that goes through a SPAC process always report how they're doing versus their original projections. And have the SPAC sponsor, if they come to market again, put in the front page of their prospectus how their companies have done versus their projections. There are many great disclosures that can be provided to the industry to actually make this another good vehicle for companies to get capital.
There is no single SPAC structure. In your view, Orlando, what is a fair structure for a SPAC? What features should a SPAC have and not have to make it fair?
I think you have to have, in addition to what I said, you have to have alignment of interests between the SPAC sponsor that's receiving the potential profits and all the investors and the company alike. So I believe that a SPAC sponsor you need to borrow good things from private equity. And one of those on alignment of interest is you have to invest real dollars behind the company that you're helping take public. So a SPAC sponsor should buy at least 10% of that pipe that gets issued by these companies. And secondly, a SPAC sponsor should also stand behind any redemptions that happen so that that company can secure the amount of capital it intended to raise in the first place. That way you have these sponsors really investing hard dollars out of their own institutions to match up the incentive arrangement.
What about warrants?
We don't do warrants. I believe we were the first SPAC or one of the first SPACs not to do warrants. I don't see why that's another necessary set of incentives. I feel there's enough with the promote that goes on in SPACs.
The SPAC craze has coincided with two other powerful trends in finance. One I'll describe with one word because it kind of sums it up, Wall Street bets, and the other is crypto. Where do those fit in your worldview?
What these two big movements are showing us is the need for inclusion in Wall Street and in the financial system by individual investors. So you take Wall Street bets. I read a blog the other day that there was a SPAC sponsor that said, well, my SPAC is not for retail investors. I was like, well, I'm a retail investor. Could it be for me? Retail investors are smart, highly educated, they make good decisions, and they want in the game. And talking about one of the arbitrage situations, they have figured out one of them in the market, and they're doing that very successfully. So good for them. Take investing on your own hands, have fun at it, and yeah, they'll take risks, and sometimes they'll make money, sometimes they'll lose money, but I think it's a really, really good thing, and it's really inclusive, and people want that in the world of Wall Street and investing. And in crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it. Blockchain technology is completely disruptive. And on top of that, the currencies, they'll be worth more if more people adopt them. And the bet is it's highly likely that more people will adopt them than less.
So when there's a Wall Street bets-driven short squeeze of whatever hedge fund happens to be short, whatever stock, are you sitting there sort of cheering from the sidelines?
I'm cheering so much because I also don't like shorting. I don't like betting against people. I don't like betting against companies. I don't like the short game. You're trying to hope somebody does poorly and even spreading potentially bad information that doesn't exist on that company. And this other movement makes hedge funds think about that again.
It's been a pleasure.
Thank you.
Thank you.
Thanks so much.